Hello, everyone, and welcome back to the AIM Summit webinar. After a short break in August, it's so great to be back with you all. We today are going to be discussing a roadmap to navigate the energy transition. And this session is sponsored by Abu Dhabi Catalyst Partners and Vortex Energy. I'm your moderator, Zachary Zefarati. I'm the CEO and founder at Down Capital. If you're joining us after the fact on YouTube, please like this video, subscribe to our YouTube channel. Now go to aimsummit.com to make sure that you can register for the live webinar so you can be part of the Q&A. It's such a pleasure today to introduce our speakers. First, we have Karim Moussa. He is the CEO of Vortex Energy, and he's the co-CEO of the investment bank and head of private equity and asset management at EFG Hermes, a prominent institution for those of you in the region. We also have another one of his colleagues, Bakr Abdel-Wahab. He is the CIO of Vortex Energy, and he's the head of energy at EFG Hermes Private Equity. Finally, we also have, it's a pleasure to have back Maral Sivzattian. She is an investment director at Abu Dhabi Catalyst Partners. Now, again, we're going to be talking about the energy transition today, how it's come to the forefront of global investment themes. But before we do so, I really want to set the stage a little bit on part of the reason that this has really come to the forefront, and that is that we this year in 2021 have seen extreme weather events. We've seen the impact that climate change is having on our real life. And we're seeing that just a year later after another global catastrophe, as we're still dealing with the consequences of the pandemic. A pandemic that we were warned about the possibility of and that we were terribly unprepared for. So in that context, investment into ESG, into the energy transition was already becoming important pre-2020, but it has really this year come to the very forefront of global investment themes for institutional investors. So Karim, if you wouldn't mind expanding on that, but before you do, if you could give a short introduction to Vortex Energy.
Sure, thank you, Zachary, for inviting me here. Hi everyone, pleasure to be here. You're absolutely right. I mean, it's becoming clear, and we're very happy that this is happening now, finally, as well on the around the globe, that major actions needs to be happening to decarbonize the system and to get to net zero anytime soon within the next sort of 50 years or by the middle of the century. Look, I run a business called Vortex Energy. I'm the CEO of Vortex Energy. It's a renewable energy investment platform. We at EFG Hermes, we've started that practice a while ago. So we started with a fund called Inframed back in 2010 to invest in infrastructure and renewables across the southern part of the Mediterranean. We've done our first investment back in 2013 with Tafila, the first 114 megawatt wind development, first utility scale wind development in Jordan alongside Masdar. And since then, we've started building that practice around renewables within EFG Hermes. In 2014, we've launched Vortex Energy, which is an investment platform that raises money primarily from the Middle East, but invests outside the Middle East in renewable energy assets. We focused primarily on Europe. We've been very successful in building that business. Over the past 5 to 6 years, we've raised in equity 500 million euros, in equity and debt around 1.3 billion euros. We've invested in Europe, aggregating assets in Portugal, Spain, Belgium, France, and the UK, in the neighborhood of 822 megawatts net capacity to us. And over the past 2 years, through a series of vortexes, Vortex 1, 2, and 3, and over the past few years, we've started exiting these vortexes. So we bundled Vortex 1 and Vortex 2, which was roughly a gigawatt of wind assets in continental Europe, and we've sold it to JP Morgan, funds managed by JP Morgan. And then last year, that was in 2019, and last year, we've sold our UK solar portfolio to Tenaga, which is a utility based out of Malaysia. And in aggregate, we've returned over 700 million euros in equity to our investors in distributions and exit proceeds, which led to 1.4 times cash-on-cash multiples and around net IRRs of 13%. So we're very happy now with our performance and our track record, and we embarked with the help of Catalyst Partners on our new initiative, which is Vortex 4. and we've successfully done our first close just a few weeks ago on $200 million. And we're also hopefully very soon about to announce as well our first transaction in the space.
Excellent. Well, thank you so much for the introduction, and congratulations on your recent first closing. Sounds like a really interesting time. You're clearly in the right place at the right time, given this investment environment, and have some impressive performance. If you wouldn't mind sharing either yourself or Bakr about how the investment landscape and the overview of the energy transition, how it's evolved over recent years, how the changes in technological advancements and the cost of developing and maintaining and operating green energy platforms has decreased to make it quite competitive.
Sure, I'm happy to take that one, Zachary. I mean, let's first start with defining a little bit what energy transition is. I mean, it's everything under our control, whether it's the technology, it's the policies, it's the ESG push to move the world to a more net zero position, where we're less relying on fossil fuels as a primary source of energy, and starting to either continue to use some fossil fuel but capture the carbon emissions, but predominantly use new technologies and existing renewable technologies to generate the key energy supply that we need. Whether it's electrification of the transport sectors, as you see with electric vehicles, whether it's the power and electricity sector with solar and wind and hydro, and whether it's also new technologies such as green hydrogen, which is coming in. So that's to put it in context. Now, if we look at why the sector is becoming more competitive, it's not anymore to do with government subsidies and holding hands of renewables. That was more 10 years ago, but now renewables can stand on their own without any subsidies. And that's predominantly because of the huge decrease in what's called the levelized cost of energy. To simplify it, it's the overall cost of producing a unit of electricity from a renewable energy plant. And that has gone down over the years by anything between 70 to 90%, depending on the technology, whether wind and solar. Why is this happening? Predominantly for two things. First of all, economies of scale. The more renewables become competitive elsewhere in the world, the more suppliers are able to, produce on a very big scale, as we've seen in China or even the Danes with their wind turbines, and also because of competitiveness. Suppliers. It's not a suppliers market anymore. It's the off-takers market. They're demanding, more competitive prices. So I think that has made renewables competitive and economical on their own, and has made them a very attractive investment also for investors.
So obviously the political environment and focus has changed quite significantly. We had the Paris Agreement some time ago, which the US dropped out of, but now we have President Biden's $2 trillion infrastructure plan focusing on green energy and decarbonization. So the US is now rejoining the global party. Could you maybe share a little bit about the heightened political focus and some of the political resistance that was seen in the past? There was always this political conjecture that mining coal was necessary to protect jobs, and that it wasn't economical. I mean, you just demonstrated that the economies have now significantly changed. But how does politics kind of play into that? Maral, maybe you could touch upon this point.
Sure. Thanks for having us back, Zach. It's good to be back. I'd say, look, on the political front, if you look at it from a market perspective, there's always been sort of two separate ways to approach the market. So the regulated market and the voluntary market. And politics has always obviously dictated what happens in the regulatory market. And those goals and those policies have become more and more aggressive in the last few years, because frankly, we need it, to allude to what you mentioned at the beginning of the call about climate change. So in order to achieve the Paris Agreement goals, what we would effectively have to do is reduce CO2 emissions by 7% annually. That's equivalent to what happened to the world in 2020 on the back of the lockdowns and COVID. So you can imagine the magnitude of the effort that has to go into this going forward has grown. It's become more important, it's become too difficult to ignore, and therefore it's becoming more and more part of legislation. But then on the other side of the spectrum, what's happening is consumers are also driving this change, because corporates led by, whether it's large corporates in the US, whether it's smaller corporates in the rest of the world, whether it's asset managers, everyone is paying more attention to this, and ESG has become almost part of the investment thesis of every proposition. So on both sides of the coin, the emphasis is changing. And whether there's penalties for not abiding by it or not, ultimately businesses and managers have to do this to keep their consumers afloat. In the UAE, as you know, the UAE produces 10% of the global oil supply. It's very, very important. It's a national priority now. The strategy that the UAE has put forward for 2050 is to increase the contribution of renewable energy to the total energy mix to 50% from 25% today. Alongside that, they want to reduce the carbon footprint by 70%. That equates to something like $200 billion in savings, and that's just for the UAE. So if you extrapolate that to economies like the US, which you correctly mentioned fell out of the Paris Agreement, are now coming back with Biden's new plan, the scale is enormous, the size of the pie is growing, the market is more attractive, and you'll see more and more institutional investors coming into this. And that's why the timing in terms of what Vortex is doing is actually really, really ideal.
So before we move on, Karim, I just wanted to pose one more question, and actually also add to that an interesting question from the audience. If we could, you talked about the investment landscape, the growth in ESG investments in ESG themed funds, and that has certainly been something that that we're seeing as a global phenomenon. Anyone who attends any investment conference, it's hard to avoid ESG being a core theme to that. Karim, if you wouldn't mind sharing a little bit about the investment landscape, and also whether you see a lot of investors or fund managers greenwashing. And this is a question from the audience, is how do you measure or prevent greenwashing in your own investments?
Look, before I start, I think, just to follow on what Maral said and also link to your question, I think by setting policies and targets, everybody knows where things are heading. And when Europe and the US now came along very recently and said that net zero target by 2050, you can extrapolate backwards how much you need to generate across all sectors in the energy space, how do you decarbonize every single sector in the energy space. And then you can calculate backwards how much needs to be invested on a yearly basis, according to capacity that you need to generate. And having mentioned that, the push is also coming from taxes and carbon taxes that we're already seeing in certain countries. So if you don't go that direction from a private sector, if you're in the industrial space as one of these sectors, you'll end up, having higher costs than your competitor by paying more taxes. So it is just a natural evolution, and there is no way back anymore, in terms of direction across all industries in the energy space. Having said so, the opportunity landscape for us as an investor is immense, because of this theme. And we, talking about, your greenwashing sort of theme, we've been doing this for the past 10 years. It's not that we came new kids on the block because it's trendy right now to invest in ESG. We've been, we've identified that theme, as mentioned 10 years ago. Now, the difference in the last 5 years, as Bakr mentioned, is primarily the government schemes and the guarantees that were given. So we as investors 5 years ago, we were chasing subsidies and government schemes because the cost of the energy produced by renewables were not competitive enough. And that guarantee by, European government or, a good credit government gives you really a good cash flow and, a 10-year, 15-year sort of predictability on your yield, which was an amazing investment theme as it stands. So away from the ESG aspect as an asset class for specifically pension funds and long-term institutional investors, it was a very nice yielding product. And that's how we also start. We liked the attractiveness of the asset class itself. Now we move into a subsidy-free scheme and a more open market, a merchant market, how they call it in the electricity space. But also it's becoming more of a commodity, and it's now an industry that you just need to evaluate on its own sort of risk-return metrics. But having mentioned the start of what I said is like the electricity demand is there, and the demand for renewables is there, and therefore the next decades to come, driven also by these policies. So when you know that whatever you're producing as a producer has a market and a demand for, that's an amazing sort of market condition to start a business there. So in my opinion, whether we like it or not, I feel the next sort of decade, the boom that we've seen in the 2000s in the internet and e-commerce space, we will see in the renewables and energy transition space across the whole sort of spectrum, whether it's technology, distribution, hydrogen, batteries, wind and solar. It's only going that direction.
On that point, you completely agree with Karim. Is actually in our business, it's very difficult to greenwash, isn't it? I mean, we're not exactly producing, say, a product in a factory, and then we're saying, look, it's from sustainable sources, and we put the stamp in it. We invest per se in renewable energy and only in renewable energy. In our funds, we are not even allowed, and we don't look at conventional energy, meaning sources from coal or gas or even nuclear, which is in a way is clean, but it's not renewable. So so from that perspective, I don't think there is any doubt in whether investors that invest with us that there's any form of greenwashing, because the investment is going into renewable energy, very clearly. And drawing on the demand point that Karim mentioned, another very big point, actually, even if the world is not growing at the same rate economically, I mean GDP wise, because electricity demand and GDP are correlated, there's so much decommissioning happening, and decommissioning of the big beasts, as they say, coal power plants, nuclear power plants, and each of those is 4 or 5 gigawatts, which in the world of renewables, 4 or 5 gigawatts is the 10% of Spain's capacity. So that is a theme as well. We've seen Germany do it. We've seen the US decommissioning, Poland, a few countries.
We've talked about this, energy transition. It's happening, right? We are in the midst of it, whether it's going to be completed by 2050 or later, depends on the pace of investment. But clearly there is a transition ongoing, and that creates, as a transition in any landscape does, it creates opportunities, it creates investment opportunities. And Maral highlighted this scale. I think the number that you said in the UAE alone was something around 200 billion, which implies on a global scale, I mean, we are talking trillions, tens of trillions of investment. So this is a massive scale. Now at Vortex, you've been doing this for you said a decade, but a lot of managers and investors are really just starting to approach and formulate their approach to this asset class and how they can capitalize on these opportunities and in the evolution of the industry. So Maral, if you wouldn't mind starting a little bit about how investment managers like Vortex capitalize on the evolution of the industry, as well as supporting this overall objective of hitting this net zero by 2050. And as you answer that question, if you wouldn't mind telling the audience, for those who aren't familiar with Abu Dhabi Catalyst Partners, what you do, what your involvement is with Vortex, and how that has shaped your relationship with them.
Sure. I'll start with Vortex and why they stood out compared to other managers we've seen in the space. And like you said, there's been a lot of traction recently and a lot more demand. But then there's also been players in the space for the last 10 years who have established track records and who have the relationships and the teams in place and who are able to pivot more quickly to be opportunistic. With Vortex, there were two things that really stood out. One is, if you want to capitalize on these trends and be well positioned to move fast, you need to have a broad enough or comprehensive enough investment mandate so that you can participate in each of the pieces. It's not just about solar plants or wind plants. It's how does that feed into the whole policy and the whole evolution towards a net zero target globally. So you need to be able to invest in traditional clean energy businesses, which, as Bakr alluded to earlier, they were long-term projects, stable cash flows, lower yields. But you also need to be able to participate in the newer technologies that are slightly riskier, slightly more adventurous, but provide that upside for investors. And Vortex's mandate enables them to do both. And then they get to do this across geography, which is very important. They get to do this across the asset development stage as well. So all the way from brownfield and greenfield through to working with large corporates on specific M&A transactions. So being able to participate across the spectrum is really important because you need to give your investors the exposure to the growth and capacity and the stable cash flow, but also exposure to the significant upside that can come from these new technologies. So mandate is important. The second thing about Vortex was the team and the track record they've built. I mean, I think Bakr and Karim and other members of the team have been working together for more than a decade. They have a very strong track record of doing deals in very relevant markets, mostly in Europe, as Karim mentioned. They've raised and deployed and successfully exited 3 funds. They have great relationships with international power producers, with leading debt providers in the space, with sector experts. And all of that comes together to give them that access to proprietary deals at a time when the market is becoming more and more competitive. So those relationships are really key. And then if you
hire you in our IR team.
Sorry?
We should hire you in our investor.
Wait, I'm coming to Catalyst. So the third piece, if you combine what they bring to the table and add scale to that equation, so you add scale in terms of capital from the right strategic partner, then they're able to participate in the much larger deals, bid against bigger institutional investors with big balance sheets. They're able to do that out of the ADGM in partnership with us, which provides them with a very competitive financial center to raise funds through a great fund domicile, great legal infrastructure, English common law, piece that all together. And you then take a regional manager like Vortex that started with a first fund of a couple of $100 million up to 500 million and the target fund size of $1 billion. And you need all those ingredients together. And to conclude on the Catalyst point, ADCP's mandate is to partner with fund managers and businesses that would benefit from having a strategic presence in Abu Dhabi and in the ADGM specifically. So it's a partnership model. We provide the capital, but we also provide a long-term partnership that supports the fund or the firm in growing out of the ADGM. We want to see these companies put people on the ground, bring in experts, bring in third-party capital to the ADGM, and contribute to the ecosystem in a long-term way. So to date, we've deployed almost $1 billion across 20 companies, and each of those companies now has a meaningful presence in the ADGM. Hopefully by end of the month, we'll have the Vortex team moving to ADGM from Cairo and from Dubai, and we take it from there.
I want to add to what Maral just said now on the Catalyst side. I mean, we're very happy to be in the ADGM and to partner up with the Catalyst partners. I think, we've been always operating from the Middle East, and Abu Dhabi with ADGM is a natural home to us. We've been always funded by Abu Dhabi linked government entities from back in the days in Vortex One. So it was only natural for us to move, and set our headquarters in ADGM. And the Catalyst really did its job as its name. We've used their seed, their name, and managed to raise money around them and have a first close on $200 million, which we're very happy with. And the target is to go even much beyond that to $750 million in the next few years.
Yeah, I've observed the Catalyst mandate. I've had the pleasure of interacting with several of your investments, be they portfolio companies, funds, and it's really incredible what you're doing. I think it's a really interesting mandate. So thank you for highlighting it. You touched upon some of the emerging technologies and the fact that you're able to look at both traditional, but as also the potentially higher risk or more emerging and unconventional spaces in the renewable sector. And there's a question from the audience from Gianluca Fossat, who asks about this next frontier, and he asks about he suggests that the next looks like the next frontier is offshore wind, but he also asks about solar, hydrogen. What's going to be the winning technology for renewable energy? So Karim, I'd love to hear your views on offshore wind, solar, hydrogen, some of the emerging technologies in this space, and how they play into the investment stack.
Yeah, I'll start, but I guess I'll lead to Bakr because he's better positioned to answer that question. I just start with also saying something that is relevant when you are an investor in the space. I mean, it's not always about what's the new thing happening. It's also very important to see what's bankable from an asset class perspective. Talking about offshore wind specifically, offshore wind was very, very expensive over the past years. It's becoming now more competitive. But if you look at the type of deals out there for offshore wind, they're always huge in terms of size. And it's usually a utility play. You'll barely find financial investors with our size, at least, unless we're a big pension fund involved in the space. The equity tickets are usually in the neighborhood of billions of dollars, and they're usually shared between big utilities in the North Sea or offshore somewhere in Europe. So it's a different play. It's interesting, but it's still not that accessible for funds like us. But I'll leave to Bakr to talk more about the technologies and the emerging technologies, I guess.
Sure. Thanks, Karim. Look, let's step back for a moment. I mean, if the world is to reach the net zero, or even some countries that aren't exactly following the targets, there is a huge push towards newer capacities of all technologies. You're talking about in the tune of around the equivalent of 200 billion worth of capex every year is needed, which translates into thousands of gigawatts. Now, which technology will prevail? Actually, all of them. I know it's a generalist answer, but technology is related to location. So you can't assume that solar is gonna flourish in Finland and the Scandinavian countries, but you would assume that these are the kind of countries that are gonna continue to build more onshore because they do have the land and it's economical there and it's very windy. Whereas countries such as the UK, now the US, Holland, where perhaps there is some constraints with land and permitting and so on, is moving offshore because it's windier out there, 30, 40 miles off the coast, and it makes economic sense and it can stand on its own without subsidies. So we are looking at all technologies, but there is enough solar PV and onshore wind, and to a lesser extent biomass type of technologies to go around for investment managers such like us before we start to look at frontier technologies. And drawing on to Karim's point, the offshore wind is a little bit like the oil and gas industry when it started. It's really for the big majors because it's a huge undertaking to build one. And it's not easily executed with a group of big JVs. You just typically see one of the major companies such as Ørsted or Eni or Enel pushing through with these, and then later on maybe they sell down to huge pension funds or insurance companies. it's an area we looked at, but from an investment perspective, it's not really our territory. Now, moving on to hydrogen. Now, that really is the buzzword. And when you ask people, well, show me where's an opportunity to invest in hydrogen, it's very difficult to point at one, except for ones, again, that are on the government level, that are pushed with companies such as Siemens or Shell, that are more prototype, but on a very big scale. But as we evolve, I see hydrogen becoming more and more a source that is used in transport, whether heavy trucking or shipping, and more opening up some of these projects for investors like us to invest when it's a proven technology. Sorry, the answer is long-winded, but it's really to say that no one technology will prevail. And finally, to say, I mean, hydrogen, if it's green, it needs to be nearer to a renewable energy source. And if you're gonna turn it into liquid and ship it, it needs to be near to a port. So again, it cannot just be anywhere. So it's location specific.
And I guess also batteries and battery technologies is also the new sort of thing, you know, and batteries itself as well, you know, its cost went down also by 90% or so in the last 10 years. And, you know, in the last 3-4 years, the installations of utility scale batteries are going up and up. So I think the next wave definitely will be storages and batteries. But you know what, I mean, in 2 years from now, if you ask the same questions, you know, we'll be answering as well with different sort of technologies. I think the industry is really moving very fast.
Are there actionable opportunities, investment opportunities now in batteries and utility scale storage, in distributed generation that are meaningful and that a fund like yours would look for or potentially bid for?
Happy to start on that one. The answer is absolutely yes.
Yeah.
Utility scale batteries, there are opportunities, and we're seeing funds like us or investment managers like us invest in some of those in the UK and Australia, particularly, where batteries are they make sense to the grid. But batteries, the issue with batteries is that there's a lot of risk attached to them as well when it comes to the revenue profile and so on. But yes, there is an opportunity. And distributed generation, just for the audience as well to clarify what that is, it's smaller sources of generation closer to the demand instead of a big power plant very far away from the demand. We're seeing a lot of those. And we're seeing in Western Europe a lot of very interesting opportunities come to market, M&A deals mainly. Rooftops on houses, rooftops on malls, in car parks, etc.
Okay, so we've talked about the different types of how the landscape for the types of investments that you might make, or the different types of institutions might make, have been evolving. What about structures? What about how investments are structured? Has that evolved, and how is that evolving to address the needs of different types of investors?
Well, it's very similar to private equity as a whole. The only difference here is that we at least see from a Vortex perspective is you have a fund or an investment platform, and you allocate to the sector. If you do that, I mean, you can allocate obviously to other funds that are dedicated to the space like us. So we're happy to, you know, receive any commitments from anybody who's interested on this code. And if you do direct, you know, with your own team, there's usually, you know, a few plays out there. The original play, the standard play that was done, you know, a few years ago that I alluded to at the beginning is like you buy an operating portfolio of assets as a financial investor, and you just, you know, you're a passive investor and you get the yield. Somebody's operating, doing the O&M and asset management for you, and you have shares in a company or in a vehicle that owns the assets, and you get the yield semi-annually, long-term to maturity. And that's a play that a lot of, you know, the pension funds and sovereign wealth funds like to do, and, you know, insurances, etc. And there's another way of investing, is also investing in the companies itself, the utilities itself, or the developers themselves. So utilities usually tend to have that stream, but they develop in-house, and then you have, you know, specialized developers that, you know, develop and sell assets. But that's a different type of approach and riskier approach. And then across all of these, there is a combination between all on that. And obviously, the easiest way is, the capital market in the renewable space has been booming as well, is to buy public markets companies that are in that space. So you really you can play across the the investment theme as you want, and then depending on your capabilities as well, your in-house appetite to get active or be passive.
I want to add, Zachary, also funds like us are very important part of the entire value chain, because when we invest for growth, so when you invest in a company, most of those funds go towards the growth of the company. And when we are just simply buying assets, most of the time, or investing in and buying assets, most of the time we're buying them from a developer, and the developer is using that money to rotate it and use it for new projects, new capex for new projects. So the whole ecosystem works that way. If there are no end investors, there won't be new capacity, because the equity needs to come from somewhere. And in a way, our LPs and our investors are also part of this, because they do fund investment managers like us to channel this money into the system and energy transition.
The beauty of the asset class is, and it's a statement I've always made back in the days when we wanted to invest in Europe and we didn't have the track record in Europe. I mean, I made that statement always, like, wind is wind. It doesn't have a nationality. It's not Arab or German or French. Wind is the same wind, whether it's blowing here or blowing in Europe. And the turbine are the same turbines, or the panels are the same panels that you install here or elsewhere. The only thing that differs is really the offtake agreement, the regulatory environment in each of these markets. So when you understand the technology and you understand the investment in the asset class, you can really easily look at new markets, obviously by doing your homework on the supply-demand situation of this market and the regulatory environment of the market. But looking at the space on a global level is very important, because certain markets show different risk-return profiles than others because of the elements that I just mentioned now. And being able to move away from a market and look at another market quickly, opens for you a lot of opportunities. So just to give examples, when we've invested back in Spain in 2016, Spain just came out of retroactive changes to the regulatory environment system that they have. And, investors were really worried to invest in Spain. And we were one of the few investors, having confidence in Spain again and wanting to deploy money in the space in Spain. Now, Spain is super hot and a lot of liquidity is chasing Spain, renewables in Spain, and the yields are, getting, competitive and depressed. And obviously, the market's dynamics have changed because of that liquidity wanting to invest in the assets. Portugal, when we've invested back in 2016, wasn't even investment grade, and so on. And now obviously it's re-rated and it became quite hot. So there are still certain markets, in Europe and elsewhere that have this dynamic that we just mentioned, like Spain and Portugal, where you still can get better yields and better returns, better pricing. That will re-rate at one point of time. There is demand for, green electricity. They have coal or gas, and they need to decommission coal, and they need to build more renewables. So the demand is there, and still it's an attractive market from a return perspective. So really, it is your ability as a manager, as an investor, to maneuver the globe and be there when there is an opportunity to invest.
For everyone in the audience, I'm loving all the questions that are coming in. I'm going to do my best to get to as many of them as we can. Nicholas, expanding on what you were just saying about how you're deploying investments, Nicholas Rives has asked a question about minority versus majority investments. What your objective is and why, and some of your in-house competencies and skills, and some of the potential dynamics differing the approach to majority versus minority.
Look, it's a very private equity type question. It's the same answer from a private equity perspective applies here. So, you're backing a developer with strong knowledge, that needs growth capital, which is effectively capital to deploy in developing their pipeline, there is no need for majority. Actually, to the contrary, you want to keep them with skin in the game as much as possible. You want to participate with them. You'll have your governance right. You'll have your protection, but it doesn't add too much to you, because at the end of the day, the developer will have to be on the ground developing, and you as an investor can help direction and help from a private equity input perspective to grow the business. So in that case, we'd rather back these entrepreneurs or these good developers with a minority stake. Now, in certain cases, like in Vortex 3, we've acquired 100% of the portfolio. Terraform Power or Sun Edison's Yieldco was selling out, non-core assets, and it was available for 100%. But in this case, it was a portfolio that was already almost operating. It had some issues. We had to replace Sun Edison with Lightsource. So we replaced Sun Edison as an O&M operator with Lightsource, the UK Solar's largest operator. And then we do have, we owned 100%, but it was just a shell, umbrella assets a company that owns assets, and we were just getting the yield. So in cases of buying, portfolios or assets, majorities or 100% even, and just gives you a higher stake in the yield. But, the operations usually always is being done by an O&M provider that is more specialized. I mean, unless you invest in the O&M provider, which is not typical, but, usually there's always an O&M provider that will do the operation. So it's really, it depends on where you are in terms of the opportunity landscape. So as mentioned at the beginning, minority stakes are, and backing, good successful entrepreneurs and developers. But on the asset class, you can own, 100% and just getting the yield and being a long-term owner of the assets.
I wanted to add to that. In our case, whether a minority or a majority going forward, and for Vortex 4, we are an active investor. So even if we are against, not against, partnering with, a management team that's very strong, and it's good to let them retain majority. We ask for the kind of rights that allow us to shape the strategy and the business with them. And those, are mainly related to economic decisions, sales, entry, indebtedness, all these things. And that's quite important, because you can also see other minority investors tagging along with developers. And this has been always a strong point that we have, that we, once we invest also, we're really close to the management team, and we're physically there. We don't just show up for board meetings, when it's needed. We actually go and we get closer to the operational team and so on. We also have an asset management team that tends to monitor day-to-day, week-to-week, the investments.
Just briefly, without getting too micro, but because your focus is Europe, and there have been quite a few questions about Europe in the Q&A. Do you have any forecast or outlook on the energy prices in Europe over the next 5 years, 20 years? From what I understand, this year has been an interesting one for electricity prices and renewables in Europe. But do you mind maybe sharing a little bit about the current landscape and your outlook on prices?
Actually, the last month in Europe, prices have been shooting up, particularly in Spain, which is a country of interest to us, as we look at it closely, reaching 100 megawatts, reaching 100 euros per megawatt hour. And to put that in context, that's quite high, as in like double the prevailing prices. And that's on the back of many things, probably some of them global warming itself. There's temperatures are higher, people are using more ACs, there's more demand and pressure on the system. We need to differentiate two things. There is what's called the spot electricity price, so the daily price of electricity, and what's called the long-term price when it comes to renewables. Renewables tend to enter into anything between 3 to 10 years in an electricity offtake agreement, a power purchase agreement. And we see those vary by country, but in Western Europe, they're anything between sort of 25 euros per megawatt hour going on to 50, depending on the circumstances. Now, will this go down massively in the years to come? I actually don't think so, because there has to be a floor to the electricity prices. You know, as technology becomes cheaper and people are bidding lower IRRs, there is a floor which I think naturally is around the 20 euro mark. And actually some governments are starting to implement floors one way or another to avoid negative electricity prices, which can, you know, spike for a few days or and so on, and they do mess up the system. I hope that answers it, because I mean, Europe is not one block really. The North Pool, which is Scandinavia, Finland, and the Nordic countries tend to have much cheaper pool prices, but again, never below 20 euros.
Another generalized question that you're probably going to hate me asking, but I'm going to ask anyway. You referred a few times to yield compression, people bidding lower IRRs. If you wouldn't mind kind of just touching upon this, what you've seen in terms of the return expectations in the asset class in general and some of the trends. I know, again, there are always specificities and idiosyncrasies, but if you wouldn't mind touching upon potentially prevailing trends and what that has meant for those that are investing in the asset class, that are long assets in the asset class.
You know, it's a very similar question like the one before. You know, you can't generalize, you know, a specific, yield across sort of different markets. So it depends from a market to market, and it depends on the supply-demand situation in electricity in these markets, hence the power price curves, but also, you know, the financing and all of that. Now, yield compression is an important point. Obviously, when we interest rates are here to rise, not to fall, and that will put some pressure on prices. Now, a lot of the purchase PPAs that Bakr mentioned, the offtake agreements, are indexed. And once you're indexed, you're naturally hedged with that sort of, you know, interest rate movement going forward. On the type of returns that you can generate, we always differentiate between the hold IRRs, which is the IRR holding the assets to maturity, which is the benchmark that you can compare with different type of asset classes. So there's one sort of number that you can compare, which is across the maturity of the assets. I would say in Europe, depending on where you are, in more sort of the developed European markets, you're looking at between, you know, single digits, mid single digits to high single digits, depending on where the markets are. And in more developing European markets, you can, you know, with levered returns, you can go to double digits IRRs on the whole level. If you model exits, improvement, and growth, you can obviously increase substantially. And with development risk, you can also, you know, get a lot of premium on that, which can get to mid-teens and high teens as well.
And that's important. When Karim mentioned on the hold level, usually investment managers like us, you have to look at the entire life of the investment. It's not your intention to hold it for its entire life, but you have to, so to be able to compare investments. Otherwise, if you assume we're going to exit this in 2 years, this in 5 years, this in 7 years, you're not comparing apples for apples. So I mean, an investment that's yielding single digit on its entire life, after improvements, maybe some more yield compression, potentially can reach double digits upon exit, potentially. I mean, in Western Europe.
So you touched upon the impact of leverage on IRR, and given you're higher up the capital stack, it would be, has access to financing, access to higher LTVs and cheaper debt financing beneath you, has that had an impact on the return profile of this asset class?
Absolutely, yes. and banks are more and more throwing debt, project finance, longer tenors, better rates, better structures towards construction of energy transition assets, and believe it or not, towards refinancing of existing assets, and in sometimes instances the acquisition finance of some assets. So there's an abundance of debt financing. And to your second question, does it increase IRR? In our case, it did, with Vortex 1, 2, and particularly Vortex 3, which is the solar portfolio in the UK, where we built that into our investment thesis. So we acquired the company, but we'd already had lined up a group of 8 banks to refinance the entire debt package within 3 months, and it has boosted our IRR by easily 200 basis points.
Yeah, and
remember, you're financing assets. Yeah, it's very little risks for the bank.
Absolutely, it's very easy to finance these assets, and they tend to be highly leveraged. I mean, if there is really long-term PPAs in place, 10-year, 15 years PPAs in place, which a lot of these assets have, it's a very bankable and very financeable asset class. So you will get to very high LTVs. You get to 80% LTVs and plus. We don't tend to over leverage them because it's just our nature, because we also looking at yield and want to get some cash out of the business, out of the selling power. So we usually go lower than that, but it's a very bankable asset class.
Well, I would argue from observations that we've seen in the market that one of the key themes driving the energy transition is the cost of financing, the cost of debt, the levels of debt and LTVs that you're able to get. The cost of financing in conventional sources of energy has not been very favorable. Access to financing has become more and more challenging. More and more banks are shying away, whereas the opposite is the case. So, while a lot of people focus on the cost of the relative cost of producing energy, which obviously, as we've already highlighted, for renewables has come a long way and become extremely competitive, and in some cases lower cost than conventional sources. I think it's also important to remember that any business making a decision is going to consider the cost of financing. If you can lever up 80% at with almost zero cost of debt in one investment, whereas another have much more difficulty accessing leverage and it's much more expensive, that's obviously going to have an impact on your investment decisions. But now again, that kind of goes back into the focus of institutional investors. It is institutional investors who have also been kind of sitting behind funds, banks across industries, encouraging them to focus on one asset class over another. So as we kind of go into the last five minutes of the session, and I'll apologize to everyone's great questions that we didn't get to, but we will share these with the Vortex team, and hopefully they can catch them later on. But I wanted to just ask each of you, for the institutional investors on this session, how they can participate in this theme, maximizing their returns and meeting their ESG objectives. If maybe we could start with Karim, then Bakr, and then Maral to conclude.
We only do renewables, so in Vortex, so our objectives are met 100%. I think within EFG, Hermes, EFG is very proud, to have an investment arm like that. At one point of time, with our 822 megawatts, we were illuminating 350,000 households with green energy. So we're definitely doing it on a 100% basis.
So sorry, what was the
question? I mean, I understand your clients, your LPs are principally institutional investors. So besides investing in Vortex, I think that would be the decision number one. Invest in Vortex if you want to meet your ESG objectives and get a good return. But how else might institutional investors achieve their objectives in ESG while maximizing returns? Is it funds? Is it buying assets?
Well, It depends on the institution itself. I mean, to give you an example, if it's an institution that has 100,000 staff across the world, then actually by using energy sources to light up their offices, entering into PPA agreements with electricity generators, like what we've seen with Google and Facebook, which are not institutional investors, I know, then that's one tick. But I'm pretty sure many banks actually in the US, big bulge bracket banks are turning to their electricity itself, their own usage as green. That's one angle. In terms of the investment, as you say, if it's not Vortex, which we prefer, it's Vortex. It could be other private equity investments, or also public markets. There are multiple. It depends on their strategy. There are multiple impact and ESG investment funds that invest in listed green energy. And they have been doing very well from the times of COVID, but the reality is that a lot of them have also gone down more recently. So multiple routes really, but I think the closer you are on the private equity side, the closer you are to the actual assets, and see really being close and making a better impact.
And at Vortex, do you allow, or have you allowed your LPs to co-invest?
Yeah, we with Vortex 4, once you become an LP, you get co-investment rights. So definitely, yeah, and we have a lot of co-investment opportunities, because usually the ticket sizes are quite large, and we allocate a portion of it from our fund, and then we open it to our investors to co-invest. And in fact, our next deal has a big co-invest room. So yeah, the answer is yeah.
So Maral, if I can conclude with you on this kind of question, and correct me if I'm wrong, if maybe it's not the best characterization, but if I can characterize you at the Catalyst Partners as kind of having one foot in each side, one foot on the asset management side, one foot with the institutional investor hat on. How would you, what would be a piece of advice that you would give to institutional investors looking to achieve these objectives in this asset class?
Well, I think, the approach we took at ADCP, as I said before, was to look at the whole ecosystem, and investing in renewable energy producers is one piece of that. So by investing in a fund like Vortex, we get exposure to technologies which are reducing existing fossil fuel consumption through better efficiencies. We get exposure to new greenfield investments and new technologies like batteries, hydrogen storage, etc. And that's through as an LP in a fund. We've partnered with another business that is a carbon offsets business, which basically buys carbon offsets from green projects all over the world, and sells them forward to corporates. So we're getting exposure there to that next piece of the market, where you have large corporates who are really trying hard to reduce their emissions, and they've got the money to put to work. And it turns out that money that gets deployed into acquiring these carbon credits is a source of financing to other projects, which is, we were talking about debt and equity, but then this is a third source of financing that's becoming extremely popular. And then finally, on sort of the more corporate or asset side, we're looking at a business that specializes in oil rig decommissioning. But what that gives us exposure to, other than oil rig decommissioning, is decommissioning of all sorts of assets, decommissioning wind turbines, decommissioning space satellites and equipment. So if you extend your vision to the whole ecosystem as an institutional investor, you get sort of exposure to each of those buckets, whether it's through a fund structure, whether it's through equity in a corporate, whether it's through participating in the underlying projects and providing an alternative source of financing. But ultimately, you have to look at the whole landscape, I'd say. And that's what we've tried to do. So hopefully by the time we wrap up our first fund, we'll have a carbon offsets business, a renewable energy fund, and a decommissioning business, all sitting within this space and all feeding into each other.
Well, thank you so much to everyone. Thank you so much for everyone in the audience. I'm so sorry that I didn't get to all of the questions. There's so many unanswered questions, but we are going to share these with everyone on the call and see if we can get answers back to you. I would like to invite everyone to this session to register for the upcoming in-person AIM Summit conference. Is going to be happening in Dubai on the 11th to 12th of October, just over a month from now. We have a great lineup of speakers, fantastic sessions. Hopefully everyone from this call will be there in person as well. So please join us. Remember, if you're joining on YouTube, please like the video and subscribe to our YouTube channel now.